For years, Larry Fink called Bitcoin an index of money laundering and thieves. Today, he runs the largest spot Bitcoin ETF on the planet and is on stage talking about sovereign wealth funds buying every major dip. What changed? And what does he see now that most investors still do not? He is telling you that state money is using Bitcoin as insurance. He spells out why BlackRock now treats it as an asset of fear, how it behaves when war risk rises or falls, and how sovereign wealth funds have been quietly stacking at 120,000, 100,000, even in the 80s. Sitting next to him is Coinbase CEO Brian Armstrong, explaining why 2025 is the year crypto regulation shifts from gray market to establishment, and how stablecoins and tokenization could move trillions of dollars off bank balance sheets and onto crypto rails. Put together, you get a rough blueprint for the next decade of crypto. That is the story we are going to unpack today. Who is really buying Bitcoin, how the system underneath it is changing, and what that means for the years ahead. Fink starts with a simple split. BlackRock's $13.5 trillion are mostly about managing hope. Bitcoin is about managing fear. People buy long-dated bonds and equities because they are optimistic about the next 30 years. They buy Bitcoin because they are worried about deficits, debasement, and geopolitical risk. Then he gets specific about who is actually buying and how it behaves when the world feels more or less dangerous. Here is the segment where he lays that out, and then Armstrong picks up the thread on leverage and regulation.
What is the purpose of Bitcoin? Then we get into stablecoin. The $13.5 trillion that BlackRock managed on behalf of our clients, it's basically managing hope. That's all it is. I mean, why would anybody invest in a 30-year outcome unless you're hopeful in 30 years you have the compounding effect? Bitcoin is an asset of fear. And when you're less fearful, like we had a trade agreement with China, you saw a shift downward. There is conversations this week that there may be some type of settlement in Ukraine. Bitcoin fell a little bit. So you own Bitcoin because you're frightened of your physical security. You own it because you're frightened of your financial security. The long-term fundamental reason you own it because of the debasement of financial assets because of deficits. And so to me, even the movement in the last week, and we've had a 20-25% drawdown, and this is the third time since IBIT was created, our ETF. And so you see these shifts, and they're actually pretty non-correlated shifts, and so the role.
But then some people say, is that really insurance, right? If you had bought it at $125,000 and it's now sitting at $90-some-odd thousand, you're saying to yourself,
if you bought it for a trade, it's a very volatile asset. You're going to have to be really good at market timing, which most people aren't. If you're buying it as a hedge against all your hope, then it has a meaningful impact on a portfolio. The other big problem of Bitcoin is it is still heavily influenced by leveraged players.
That's what I wanted to talk to you guys about.
Okay, actually. I mean, that's Bitcoin, but we can see, because we see where the flows are coming from, we're seeing more and more legitimate long-only investors investing in it. There was an article about a foundation, endowment just bought a lot of IBIT. But I can tell you there are a number of sovereign funds that are standing by. They're adding incrementally at 120, at 100. I know they bought more in the 80s. Right. That's fine. And they're establishing a longer position. And you own it over years. This is not a trade. You own it for a purpose. But the market is heavily leveraged. And that's why you're going to have more volatility.
Okay, so Brian, let's talk about that, though, the leverage piece, because I think we all don't know where all the leverage lies. I think some people Michael Saylor has a company strategy, formerly MicroStrategy. That seems like a big levered bet. He owns about 3%, I believe, of all the Bitcoin that exists. How much leverage is there really?
Well, yeah, I mean, we saw a little bit of this on October 10th this year, and there was quite a bit of leverage that got unwound as the market moved around a little bit. But this largely happened on offshore exchanges, right? On Coinbase, we saw very little of this. And to me, it's just an example of why we need clear rules on the books in the United States. I think 2025 is actually, we'll look back on this as the year that crypto regulation went from kind of gray market to well-lit establishment, because we saw the passage of the Genius Act, which was huge for stablecoins. We've now seen a bipartisan vote for market structure legislation in the House, and now it's going through the Senate. And so Hopefully within a few months, we might get a vote on that in the Senate. And then I think we'll have the foundation to really have this industry be built in the US, and we'll see a little bit less of this kind of leverage or high risk activity happening offshore.
Fink draws the new map very clearly. Bitcoin is a hedge against the world you are scared of, not the one you are cheering for. It responds to trade deals, peace talks, and war headlines because it is wired into perceived risk. And the price action is still distorted by leveraged players, which is why you keep seeing 20 to 25% drops in a matter of days. The punchline is who steps in when that happens. He says there are a number of sovereign funds standing by. They are adding incrementally at 120, at 100, and he knows they bought more in the 80s. They are not chasing blow-off tops. They are building positions into fear for the long term. That is your smart money signal. Offshore traders crank up the leverage, get liquidated, and create the volatility. Sovereign wealth funds dollar cost average in size and sit on the coins for years. They treat Bitcoin as strategic insurance on national balance sheets, not a short-term punt on the next headline. Armstrong then points out that most of the nasty leverage unwinds have happened on offshore venues, not on Coinbase. His answer is simple. You fix that by pulling activity into better regulated rails with clear rules in the United States, not by pretending the demand does not exist. He calls 2025 the year crypto regulation shifts from gray market to establishment after the Genius Act for stablecoins and the new market structure bill. So already you have two anchors. BlackRock is framing Bitcoin as an asset of fear that hedges deficits, debasement, and instability. And sovereign wealth funds are using that thesis to build into big drawdowns, while the regulatory arc slowly drags activity out of the shadows. Next, we need to look at the wiring underneath that trade, tokenization. If Bitcoin is the hedge, tokenization is the wiring that lets serious money move around it. Fink recently wrote about this in The Economist. On stage, he pulls the idea out of theory and into the real world, talking about what happens when every major asset is digitized and connected to digital wallets and stablecoins.
But I think you have a view that tokenization is effectively going to change finance forever.
Yeah. Want to explain?
Explain.
Okay. There's so much conversation going on about AI and how AI is going to be reshaping the world. There's not enough conversation about how technology is going to be reshaping the financial services area too, and the need for democratization. As Secretary Besson talked about the democratization of investing in America. There are slews of middlemen in the whole financial services area. We have elongated settlements, elongated processes. If we could digitize every asset, so if we could digitize all stocks and bonds and have it more seamless going from a digital wallet of cash or stablecoin into equities or bonds through, in most categories, through an ETF, it will reduce the friction costs, the transaction costs, and it allows a much more free flow. So there's $4.1 trillion of money in digital wallets globally, sitting in stable coins mostly. And can you now, and right now, if they wanted to go into a bond or stock or have a real estate transaction, they have to take the money out of the digital wallet into a traditional wallet and have all those commissions and fees and all that stuff. So the whole idea of tokenization of all assets, including real estate ultimately, is going to just reduce huge friction costs, making investing easier, simpler. You could, as the secretary was talking about this one account, you can do this all through your app, and it's going to allow a more, I would say, a free-flowing process of investing.
He is talking about traditional assets that already sit in most portfolios: stocks, bonds, real estate, funds, usually wrapped in ETFs. Right now, there are billions of dollars parked in digital wallets around the world. If you want to move that capital into a bond, an equity index, or a property deal, you usually have to off-ramp into banks and brokers, wait for settlement, and pay a stack of fees. Tokenization cuts through that. In Fink's version of the future, you move directly from a digital wallet holding cash or stablecoins into tokenized stocks, bonds, funds, or real estate, often through ETF structures investors already understand. That slashes friction and speeds up settlement. More importantly, it puts crypto money and traditional money on the same rails. For Bitcoin, that changes the game in two ways. First, it makes it easier for institutions to move size in and out of Bitcoin exposures alongside tokenized bond funds and equity ETFs from the same wallet environment. Second, it changes how allocators think about the stack itself. Bitcoin as neutral, non-sovereign collateral. Stablecoins as the transactional layer that everything flows through. Tokenized securities as the yield and exposure layer that sits on top. Once that stack is in place and credible, it becomes much easier to treat Bitcoin as just another sleeve in a fully digital portfolio rather than some separate exotic bet. Armstrong's role in this picture is obvious. Coinbase wants to be the infrastructure that underpins this world, custody, trading, and tokenization for funds and other assets, serving both retail and institutions. So tokenization here is not a marketing term. It is the bridge between today's spot Bitcoin ETFs and a future where most assets and most flows live on-chain in some form. As soon as you talk about tokenization, you run straight into stablecoins and banks. If trillions of dollars move into tokenized assets, those dollars are moving out of traditional bank deposits. That is where the tension sits. Sorkin presses that point. Armstrong gives the blunt answer. Then Fink pulls back and looks at the global scoreboard.
I think banks have been frustrated or anxious about some of this, has been the idea that there's going to be a flight of capital effectively out of the banks that's going to go to effectively support the stablecoin business, which ultimately will support in large part some of the transactional issues and potentially even some of the tokenization projects.
Well, in that case, I think that's just the banks trying to protect their profit margin. I mean, they should have to pay rewards and higher rates to their own customers. And I think they're trying to put their thumb on the scale of regulatory capture, essentially, to prevent crypto from doing that. But my prediction is actually the banks are going to start, we're already seeing this actually, they're going to be increasingly embracing stablecoins. And my guess is that in a year or two, they'll come back and say, actually, we want to be able to pay interest and yield on stablecoins in our own companies. And so it goes back to that innovator's dilemma situation. I mean, the best banks are leaning into this as an opportunity, and the ones who are fighting it are going to get left behind.
I would say as a country, we're late.
We're late.
Yeah.
We're late. So
Who's ahead of us?
India and Brazil. So this is the biggest issue. We are a successful nation. So much of the foundation of our success has been the role of the capital markets. And this, if you think about how the U.S. economy was able to restabilize itself faster after the great financial recession, is because of the role of the capital markets. Now, the secretary was talking about the role of private credit, but it was really the capital markets. And we are now starting to see in Brazil and in India a whole transformation of a digital economy. And they've digitized their currency. Now, you even have now credit card purchases on the pipe in Brazil itself, the PIX. And so what I am worried about, we're not moving fast enough. And, and so I didn't put this in the article because, I didn't want to be that vivid on this. But this is one of my big fundamental issues. We need to move faster. We need to move faster as a country, even in AI. I mean, you haven't asked the question. When people say, is there an AI bubble? I ask, well, if we don't continue to spend on this, and that means we're going to have some failures and some success stories, but if we don't spend enough faster in AI and digitization and tokenization, other countries are going to beat us.
Armstrong does not pretend this is about consumer protection. He says it plainly. Banks that fight stablecoins are defending their profit margins, not their customers. If they want to compete, they should pay better rates and rewards. And in the end, many of them will adopt stablecoins and offer yield on them inside their own platforms. So the fight right now is about economics, not about whether stablecoins exist at all. The likely end state is banks, asset managers, and crypto firms all using stablecoins as the basic plumbing layer. Then Fink looks up from the plumbing and talks about the race. He says the United States is late. India and Brazil are already ahead on digital currency infrastructure and instant payment rails. And if the US drags its feet on AI, digitization, and tokenization, it will get beaten. That is the bigger frame for everything we've just talked about. Bitcoin, stablecoins, and tokenized assets are not just technologies. They are part of a fight over which countries own the core infrastructure for the next financial system. The US still has real advantages. Foreign investors are heavily overweight US dollar assets. American capital markets are deeper than almost anything else on Earth. But if payment rails, tokenization, and regulatory clarity fall behind, that edge starts to erode. Capital may still want dollar exposure, but it will travel through whatever jurisdictions make it easiest and safest to hold. For Bitcoin, that means the real battle is not only about ETFs, it is about where the core liquidity, custody, and settlement stack ends up being built and controlled. The last part of the discussion ties everything together. Armstrong talks about a kind of golden age for freedom built on crypto rails. Fink drops it back into the macro picture that investors have to navigate.
One is just, and so 30 seconds each. Where do you think we are in the economy right now? If we were back here a year or two from now, would we be in a materially better place? How do you see the markets?
Go first. I mean, I'm an optimist, right? I think that it's kind of a golden age for freedom that's happening with, democratization of access to these different products with crypto. We're seeing prediction markets really start to flourish. We have regulatory clarity now for stablecoins. We're seeing it emerging, hopefully, for market structure. And the U.S. feels like it's back on offense. We have a chance to go update the financial system with crypto and just get a lot of the friction out of the economy. Going into the midterms, who knows? Maybe the government will want to juice the markets, do some more rate cuts. So I'm generally optimistic, and we try not to get caught up in any short-term trends. We just try to build good products and play for the long term.
Larry, what do you say?
So managing the large, 40-something% of our assets are foreign-owned assets. Both, they have a 70 to 80% allocation of their portfolio in dollar-based assets. This is the place where they want to invest in the opportunity. Obviously, earlier this year we saw maybe a 3 or 4% reduction, but they're still heavily overweighted. And so I think that is one of the great powers that there are very few destinations where capital is seeking long-term opportunities. That being said, we have to ask the question, why is the job market in 2025 so anemic? Last year, the job market averaged 154,000 new jobs every month. This year, we're averaging 31,000 jobs. That's not part of the conversation. The question is it the uncertainty around all the policies that are being created? If that's the case, when there's more certainty, are we going to see a surge in job growth next year? Well, that's an inflationary outcome. The counterpart is, are we seeing this anemic job market because the futures today, we're now beginning to see more labor substitution because of technology. That's a very deflationary outcome, but that has a profound impact on how we navigate.
Which one do you think it is?
I think it's both, but I think the trend of technology, you're starting to see that. If you look at corporate margins, especially the leaders in every industry, are winning more and more share. So we are seeing this K economy developed in every industry. And what I think is happening is more and more companies are doing more with the same amount of people or less people. I mean, if you think about the ratio I think about BlackRock, our revenues are up 40%, our headcount's up 5%. Okay, so our margins are up about 300 basis points over the last few years. And so with technology, you're able to, transact more volume, more business. You have more technology doing much more of the fundamental, the backbones of what we do as a firm. I mean, having $13.5 trillion, we do a lot of trades, and we have thousands and thousands of different criteria that each investor gave it. And it is all done through technology. And so this technological change is happening today, but it's going to have a profound impact on our economy. It's going to have the biggest impact is what do we do with our university system? We built a university system in the United States based on white-collar jobs. That's going to be changing with technology. How is that all going to be reshaped? We need to be answering these questions, and I don't hear people asking the questions.
Armstrong's focus is on how people actually use this stuff. Prediction markets, stablecoins, and tokenized assets are not just new trading toys. For most people, prediction markets are a signal about what is likely to happen in the real world, an alternative to polls and headlines. And with clearer rules around stablecoins and market structure, he thinks the US has a real chance to modernize its financial system and strip out a lot of friction. Then Fink zooms back out. He reminds you that foreign investors still allocate heavily to US assets because there are very few places that look as attractive for long-term capital. At the same time, the US job market has weakened, and technology is creating a K-shaped economy where leaders in each industry grow revenues with far less headcount growth. Inside BlackRock, revenues are up, headcount is barely up, margins are higher. Technology is doing more of the work. That has two big consequences. It makes inflation and employment harder to manage for policymakers, and it ramps up the pressure on governments that are already running large deficits and constantly issuing new debt. In that environment, BlackRock's asset of fear framing for Bitcoin clicks into place. You do not buy Bitcoin because the world is calm and predictable. You buy it because you expect more policy stress, more experiments, and more dependence on digital rails to keep the system moving. Step back from the details and the picture is fairly clear. First, the narrative at the top has flipped. Bitcoin is no longer dismissed as a toy. It is treated as a volatile but credible hedge against deficits, debasement, and geopolitical risk. Second, the key buyers are not retail traders chasing green candles. Sovereign wealth funds are adding on deep pullbacks at 120, 100 and into the 80s, with the intention of holding for years. Third, stablecoins and tokenization are not side projects. They are the pipes that let trillions in digital wallets flow into tokenized stocks, bonds, funds, and Bitcoin products on the same rails. Fourth, there is a real geopolitical race. India and Brazil are already ahead on digital payments and infrastructure. If the US moves too slowly on AI, tokenization, and financial innovation, it risks giving up some of the edge that comes from being the core of global capital markets. Put it all together, and you get a simple structure. Bitcoin as the asset of fear, stablecoins and tokenization as the plumbing, BlackRock and Coinbase as two of the main operators building and selling that system to governments, institutions, and individuals. The volatility, leverage, and politics will keep grabbing attention. The quiet, methodical accumulation by sovereign wealth funds and giant asset managers will not. But that is where the real signal is.